Welcome to MasterTrader, where you learn simple market analysis to make money investing and trading in the markets. I'm Dan Gibby, and in this chart of the week, although at MasterTrader we trade both directionally, stock and option trades where multiple time frames are in alignment and we're expecting a big move, we also have what we call these income trades, which is the subject of today's lesson, where we simply sell options and credit spreads around compelling turning points in the markets, and we keep that premium that we received as our income. Now, over the last 6 weeks in our weekly options trader, we've closed 61 of 65 for winning trades or a scratch. And there's a lot of quantitative option traders where they say nobody can read chart direction, it's a coin flip, it's 50%. Well, 94%, and we've been doing this for decades, just flies in the face of that logic. And we think any trader who doesn't internalize and use the value of chart analysis with a directional bias is just trading like an ostrich with their head in the hole. Let's take a look at this strategy and why it is so compelling. Very simply, stocks can only do one of three things. They go up, higher highs, higher lows. They go down, downtrend, lower lows, lower highs. Or they're consolidating, they're resting in a sideways trend where we have relatively equal highs and lows. What we do at MasterTrader is everything starts with a chart. Our subscribers hear me say over and over again, no setup, no action, no setup, no trade. I don't even want to hear about it. So then based on the trade is when we dictate whether we're recommending a directional or an income trade and how long we want to be in it, etc., picking the right strikes. In selling credit spreads, we're going to be selling these credit spreads where we're making a bet that the short-term low, if we're selling a put spread, or the short-term high, if we're selling a call spread, is going to hold through expiration where we get to keep that premium. A bull put credit spread, we're going to be selling one out of the money put, buying a further out of the money put. I'll show you in more detail in a moment. But look at why we benefit of 2 out of 3 directions even without a chart bias. Now you add on our excellent chart analysis and method at MasterTrader, and it just stacks the odds overwhelmingly in our favor. So if we're calling a short-term bottom in an uptrend or even a sideways trend, we're going to profit if the stock goes up, if it just chops around sideways, and it can even go against us all the way down to the break-even point before we start losing money. Bear call credit spread, I'll show you an example, but it's the exact opposite. We're going to win in 2 out of 3 directions by picking a short-term high. The cushion that we receive, which means the premium that we're putting in our pocket the moment we sell a credit spread, and that improves our cost basis to break even, that gives us the cushion to be wrong, as we say, meaning the stock can go against us and we still make money. When we sell premium, we're acting actually like an insurance company or even running a professional casino, Wynn Hotel, because we're selling premium, we're getting paid on each trade, and it's ours to keep unless we have a huge gap against us or a huge quick adverse move. I'll show you that. These are what we call MasterTrader money patterns. They're just simple candlestick arrangements. I'm not telling you what time frame they're in. I'm not showing you multiple time frames, the trend, support, or resistance. That's what the MasterTrader method, that we put all of our concepts together to make up our approach in trading stocks and options. But I'm just going to show you real simply here what we do in selling put spreads, and then call spreads obviously is the opposite. So we start with a compelling pattern. These are all compelling bullish reversals. What we're going to do is sell an out of the money put, so that obligates us to buy the stock at the strike price on or before expiration if the put buyer wants us to. We're going to take some of that money that we received and we're going to buy a further out of the money put. And what that does is lowers our buying power requirement at the brokerage firm and also limits our potential maximum loss in the event we do have a catastrophic gap against us. Our potential credit is always the money that we receive when we sell options. The potential max loss in this strategy is the spread width, and you'll see that we do a lot of $5 wide, $10 wides, less the money that we put in our pocket. Now let's show you again our approach, our service, and some of the trades from last week. This is our Telegram alert, but this is our approach. We have a Telegram alert for all three of our advisory letters, our swing letter, this ETF. This is our weekly options trader letter, and we have an ETF letter that trades ETFs on longer time frames. Every single setup, we give this symbol, of course. We give the technical setup, so remember, no setup, no trade. We give what the trade is, and we give a stop loss. This is the setup of every one. This is Netflix. We're saying let's consider selling an out-of-the-money put spread. The stock's trading at $297. We're going to sell an out-of-the-money $280 put. We're going to buy a $270 put, so that's $10 wide, 10 DTE, so 10 days to expiration. As long as this bottoming pattern goes up, chops around sideways, or even could go down against us over $17, we still make our 76 cents a share. So hypothetically, if you sold 10 of these put spreads, $760 will be immediately deposited into your brokerage account. This is what, if you're a subscriber, this is what you will see. I just grabbed a screenshot of what our subscribers saw. And then obviously we have our stop loss. Some option traders say, don't ever take a stop, just roll in perpetuity. And whenever I hear that, I picture that bale of hay on fire just rolling down the hill. That's a quick way to make your bad trade even worse. And then once we're in the trade, we send subsequent trade alerts, managing the trade all the way until conclusion. And then we have every trade with adjustments, open and close, in a spreadsheet in the members area. Example here from last week, VMW. Everything starts with a chart up, obviously. This big green, it broke out, gap down to support and the 20 and 50 moving average. Rallied, took out the high. We sold an out-of-the-money put spread, 85 cents a share, and that expired worthless. 214 was last Friday. It was this day, and that expired for full profit. If you did a 10 lot, 850 bucks. Restoration Hardware, we did last week. We shorted on this particular day right here, we sold a put spread, the 215, 210. We sold it on February 10th. It expired the 14th. So we had 4 days of risk, folks. 4 days. This is what we call a wide range igniting bar from multi-month consolidation with the 20 rising 50. This is what we call a no-brainer setup. And I mentioned to you earlier that we do both directional trades, and today I'm talking about just these income trades. But this, we also gave to our subscribers were trading this as a directional trade, because that's a powerful setup. So using charts in our method, we ask ourselves, what is the likelihood of this trading under 215, closing under 215 in 4 days, with the stock being over $225 at the time, over $10 higher? And using our approach, that has a very, very high odds of closing above that level. 55 cents a share for a $5 wide. So if you did a 10 lot, that's 550 bucks. And 2 days later, so at this big green bar here, 1 day, 2 days later, we closed it at a nickel. So we made 91% of our maximum gain. And remember I said, put your risk management hat on whenever you're trading credit spreads. So we're an insurance company. If we can make 91% of our max gain in 2 days and eliminate another 2 days of potential risk just to try to squeeze out another nickel, Doesn't make sense. And we teach all of this in great detail in our mastering credit spread courses. Here's one, Apple. It's been on a tear this year, been on a tear. It had a breakdown here, rapid rise back up to resistance. We had a gap down failure. We had a red bar ignored. These are all concepts we teach in our swing trading course of how to read objective price action of anything that moves. So on this breakout day over the red bar, you see here on February 12th, we've sold this put spread, folks, 2 days of risk, 2 days. With this pattern and this gap reversal and this red bar ignored, here's my 310 strike, way the heck down here. We sold a 320 put, bought a 310 put, 60 cents a share. If you did a 10 lot, $600 goes into your bank account, by your brokerage account, and it's yours to keep as long as it closes above 310 2 days later. It obviously did. This is expiration Friday on February 14th. But then when momentum slowed, I'm showing you another twist of what we did to this particular trade for our subscribers. When it was showing relative weakness on expiration day, we kept our put spread open because the likelihood with it trading at 324 of dropping 15 bucks in a day is very low, but we had our stop loss in anyway, as we always do. We sold an out of the money bear call credit spread, 327.5, way the heck over resistance. We did a $5 wide. We took in 15 cents a share. So if you did a 10 lot, another $150 is deposited into your brokerage account, bringing our total potential gain to 75 cents a share. And we obviously give a stop on the call spread. We already had a stop on the put spread, and we said let it expire worthless. And you see it closed at 324.95, below this short strike, above this short 320 short put strike, and that was a beautifully executed trade. If you go to MasterTrader.com/swing trading, this is my partner Greg Capper. He's the most amazing technician in the industry, been at it almost 3 decades. This is an amazing thought-building modules put together to teach you how to objectively trade anything that moves. So these patterns that you're hearing me talk about, the trend, the support and resistance, the red bars ignored, the gap down failures, the tails, etc. This is all the stuff that you will learn in this course. I don't care if you're new to technical trading or if you've been at it over 20 years like some of our subscribers. This course will drastically improve the way you look at charts forever, I promise you. We love selling short-term expiring options. In fact, the weekly options trader, which all of these trades I'm showing you today come from that, we only sell options and spreads that expire 10 days or less. That is because, I'm showing you this little hourglass here, because the time decay which erodes against option buyers is eroding into our pocketbook. That's our profits. It's the Greek, that's what's referred to as theta, that's time decay. It's the amount that the option erodes for every day of decay. This was a big, so I have my daily chart on the right. It's a big bullish gap, but on earnings days and 0 days to expiration trades, we love fading things with a proper setup, of course. Has to be a proper setup. Could this have been a gap and go? Well, it actually was, because notice the topping tail. So the shop opened up here, rallied there, got slammed back down. Here is my intraday chart. Here's my 15-minute chart. So we don't enter anything unless we have multiple time frames in alignment. This was pre-market climactic run, pre-market. Then here is my topping tail that we see, the topping tail here. I see I pointed on both time frames. So we, under the 15-minute low, we sold, look at the alert for our subscribers, we sold the $600 calls and bought the 605 call, so a $5 wide, 90 cents a share. That is massive, massive return if it expires worthless. So how you calculate your return on capital of these credit spreads, so you take the 90 cents a share, you divide it by your max loss, which on a $5 wide is $5 less 90 cents, that's $4.10. 90 cents divided by 410 is a whopping 22% return on capital, folks. Now that's not to say your account is going to return that all year long. I'm just talking about trade by trade. And we sold it, let me just eyeball this, let's just call it 565. So think about this, folks. We're saying, I don't care if the stock chops around and goes sideways, if it goes down as it did in this particular example, or it can even go up $35 against us, and we still make 90 cents a share. If I sent out a marketing piece and I said, hey, I'm going to teach you all how to make money if the stock still goes $35 against you, you should just hit the delete button, because it sounds like I'm a charlatan. But I'm showing you these examples. This is the power inherent in shorting credit spreads around the charts using the MasterTrader method, not just blindly selling out of the money 30 delta calls and puts like some services do, saying the statistics are on my side, there's a 70% chance probability of expiring worthless. Those statistics are meaningless unless you have a bias with the charts, in our opinion. So this one, we call it a no-brainer setup. It had a buying exhaustion. We have high volatility because it had earnings, and we love doing that, selling high volatility premiums with the charts. And even though it was a 3-day to expiration, well, 2-day to expiration, 212 to 214, we got out into weakness, and just so we booked 78% of our max profit in 3 hours. We said, just take it, just take it. And I think we did that, I forget where, either in one of these bases. All right, let's continue. One or two more examples. Just a bear call credit spread showing you the opposite of how we also do these on bearish patterns. Disney had earnings here on February 5th, had a big gap up. It was getting sold into. We got a bearish intraday entry, and we sold the out of the money 147, 152 call spread, 45 cents a share. We gave the setup. On 212, we said, hey, the midpoint is 6 cents, let's move our stop, and that expired worthless last Friday also. We absolutely love selling these zero DTE trades on the S&P 500 ETF Spider, SPY, and also obviously on expiration Friday with all the weekly expirations, and third Friday of the month on the monthly expirations. And that's because of the time decay that we can make on Monday, Wednesday, Friday on selling them on spiders. And we do everything I've just been showing you. You should print this chart out. This is our checklist. You can do it on your universe, but as I said, spiders have multiple expirations. We want a bullish setup, we'll sell a put spread, bearish setup, a call spread, and these typically set up in the first hour, which makes our green trading room invaluable. For active traders wanting to monitor this in real time with us. We obviously send them out via that Telegram alert to the subscribers of the weekly options trader, but in the live trading room, you're overlooking our shoulders. You're watching the setup with us. We're talking our way through it, and it's just more intense and educational. Obviously, everything has to be liquid. You want good premium. We teach you that in our courses. Follow your trading plan. You can close it out into expiration just to avoid any potential assignment risk. And if you want to learn how to now do this strategy on your own that we've been talking about in today's lesson, go to MasterTrader.com/spread trader. We have the advanced course, which is 5 modules to get you started in selling these, paper trading them, watching our trades. We have a gold package, which is the mastering. It's like a grad course of this. It's 12 very detailed modules. 99% of the people who take silver just to get their feet wet, they upgrade to the gold, and we allow you to apply the $97 to this, because we know that most people want to do that, and we want you to learn, obviously. And then for just again a no-brainer, extra $100, we're throwing in 3 months of our green trading room, which costs $97 a month in and of itself, and 3 months of our weekly options trader, which again, these trades I've been showing you today, every single one of these came out of the weekly options trader just this past week, which you saw the statistics. The last 6 weeks we've been on a good run here, 61 out of 65. Hope that helped, folks. Take a trial. You can watch us also on our MT Live every Wednesday at noon on YouTube. Good trading, everyone, and hope to see you in our trading community.